Hey, welcome back to Everyday Economics. This is the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug. I'm publisher of the Center Square Newswire service. Everyday Economics is brought to you by the Center Square. To support Everyday Economics, please make a tax-deductible charitable contribution. You can do that by clicking in the show description. There's a link just waiting for you to push. We're recording this episode on Monday, December 8th, and joining me as always, it's Dr. Orphe Divounguy, a man who needs no introduction, but he is a PhD economist. Dr. O, each week at the Center Square, you write a column about what's happening hot inside of the space of U.S. economics. And this day published has been a piece from you on the case for the Federal Reserve to cut rates. We've been talking about this for a couple of weeks. But there's really no question in your mind. This is a gotta do.
Yeah, I mean, the way I framed it is, well, tired demand and a fragile labor market. And then, of course, you have the fact that everything almost rests on high income households continuing to spend, which is, in my opinion anyway, dangerous, right? Because if you start to get weakness on this one side of the equation, right? Where if say, stock prices fall, this kind of asset price driven expansion could come to an end. And so, I think that's the case for December rate cut. When you look at the Fed's mandate, right, kind of you look at inflation. Well, inflation came in lower than expected. Core inflation's basically been going sideways, for the past couple of months. Of course, we don't have an October. We're not going to get an October inflation report, but the last one that came out last week was for September. And what September showed was that core inflation had actually was 2.8% instead of 2.9% in August. So going sideways, you might say. But on the other hand, the unemployment rate has gone up and the labor market has weakened. And so, you look at all of that and you think, yeah, a rate cut is necessary.
Is the Fed, in your opinion, is it moving fast enough? And I'm not asking for like a hardball opinion here. I mean, certainly with the government shutdown being, what it was, everyone suffered from the same limitations to data. I don't know that there's been a decision opportunity, that's occurred that the Fed's missed on, that they cut rates the last time through, consideration. But, or I'm sorry, did they hold rates the last time that they had an opportunity? They cut. It was just a matter of how much, right? And so we've seen quarter point cuts. Are you anticipating another quarter point cut?
Absolutely. I don't know if more is needed, right? So yes, the labor market has weakened. Yes, inflation has come in lower than expected, but it's still been, if you look at headline inflation actually increased, right? So goods inflation up 1.4%. Goods prices are up 1.4% year over year, up from 0.9% in August. And so goods prices have increased, as expected, partly due to the tariffs. So yeah, I think the Fed's just right on the money right now. It's a quarter point cut. It's wait and see. Hopefully we get some November data, that points to, things not changing too much, right? No surprises in November and December. And if we get no surprise in November and December, we could get another rate cut in January. But as of right now, my base case is for a pause in January. We get the data and then perhaps the Fed resumes again in March. So they're going to need to see what's happened since September, essentially. We know from the labor market, from private sector data, that the labor market has continued to weaken, right? That in October, net hiring had turned negative. And so, the big question is, will that continue, or could that kind of, could we have had a bad month in October, and then November will be okay, right? So, but everything points to a weaker labor market. And I think the balance of risk has shifted, and the Fed needs to be paying more attention to the weakening of the labor market.
So let me ask you this question. You referenced tariffs just a few moments ago, and you wrote in this week's Everyday Economics column the following, and this is where you're basically making an analysis of core PCE, the
core inflation, personal consumption expenditures,
right. And you wrote the following, well, let me give you a little bit of a run up here. You said, core PCE, which strips out food and energy, also rose 2.8% from a year ago, down slightly from 2.9% in August. Goods prices moved higher as tariffs filtered through. While services inflation ticked down, prices for goods were up 1.4% from a year earlier, September versus, August.
Yeah.
While services inflation eased to 3.4% from 3.6%, you wrote the following. So far, and you wrote what I just read as well. So far, that's a far cry from the worst case fears that tariffs would send prices sharply higher. The September report instead shows a modest reacceleration in goods prices layered on top of a slow grinding disinflation in services. So, I mean, tariffs have been a moving target all year long for a number of different reasons. One, tariff rates were established and then changed again, depending on what was going on in our relationship with any given country. As you look back on tariffs now, which have kind of escaped the headlines, I don't know that there are a lot of conversations around tariffs as there were earlier this year. Where do you see tariffs at this point and impact the tariffs have had specifically on consumers?
Yeah, I mean, you see the impact on businesses, right? You see it in the PPI, where basically, goods prices that were expected to go up went up. So you see that there. Consumers are seeing a little bit of it, but not quite as much. And part of that is because businesses are kind of absorbing the higher costs. And so you see this kind of, margin compression, right? And so part of it is absorbed by businesses. The other part of it is getting passed on to the consumers, but not to the extent that everyone thought, previously. And I think that has a lot to do with the fact that demand has weakened, right? And that the labor market is fragile, that people are not flush with cash like they were during the middle of the pandemic. They don't have the savings, the bulging savings accounts anymore. And so the majority of Americans are pulled back on their spending. And so if you have a majority of people pulling back on their spending, businesses can't pass on the cost to consumers. They just can't, right? So that's what's going on. We know that, high income households supported by strong balance sheets, equity gains from, AI stocks are still spending on services, right? But ultimately, it's just not enough to keep this. I don't think it's going to be enough to keep this economy humming. And so that's why the Fed has to be careful and cut again.
Well, I appreciate your thoughts as always. And I appreciate that succinct answer. We'll call it good for now. Or just remind everybody, Orphe's column, publishes every Monday, in the Center Square. Sometimes it, comes out a little bit earlier on Sunday night. If you want to be first to the opportunity to be educated, make sure you keep an eye on Everyday Economics each week at the Center Square. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics wherever podcasts are hosted, and make sure you listen to Orphe and me each week on the Center Square Radio Hour.